China is quietly dumping US Treasury bonds, and it could shake the global economy. Rising yields, a falling dollar, and global realignments are already in motion. Let's break down what this really means, and what smart investors should do now. Welcome back to The Alternative Investor. I'm Robert, and today we're diving deep into a financial shift that has massive implications for the global market. China is reducing its exposure to US debt. This isn't just about bonds, this is about power, positioning, and portfolio risk in 2025. China currently holds around $759 billion in US Treasury securities. That's nearly 10% of all US foreign-held debt. But over the past year, China has been quietly reducing its stake, a trend that's now accelerating. Why? It's not just about economics, it's about leverage. Amid growing trade tensions, tech wars, and geopolitical friction, China is signaling that it's no longer willing to rely so heavily on the US dollar-based financial system. Selling off treasuries not only diversifies their reserves but also puts subtle pressure on US borrowing costs, especially as the US runs record deficits. This move is calculated, and it's sending a message. As China sells, yields rise, because when demand for bonds falls, their prices drop and yields go up. In just the past week, the 10-year Treasury yield has surged past 4.51%, while the 30-year briefly broke above 5% before retreating slightly. That's a big deal. These yields impact everything: mortgage rates, auto loans, business credit, even credit card APRs. What's unusual here is that yields are rising not due to economic strength, but due to concerns over who will buy our debt. That's a red flag for long-term investors. The US government runs on debt. It sells treasuries to fund infrastructure, defense, social programs, and more. When foreign buyers like China step back, it puts pressure on the Federal Reserve or domestic investors to pick up the slack. This creates multiple ripple effects: higher interest rates to attract new buyers, inflationary risk if the dollar weakens, and budget stress as interest payments rise on existing US debt. Think about it. If the US pays more to borrow, that money has to come from somewhere, possibly meaning higher taxes or cuts elsewhere. This isn't just about the United States and China. Other nations are watching and reacting. China has already ramped up its gold reserves, increased yuan-based oil contracts, and strengthened trade ties with BRICS nations. Some see this as the beginning of de-dollarization, a slow move away from global dependence on the US dollar. If China and other major economies continue dumping treasuries, the dollar's status as the world reserve currency could be challenged. That would upend decades of global trade norms and potentially increase volatility in everything from oil prices to currency exchange rates. Here are 3 strategies to consider in this evolving landscape. 1. Diversify beyond treasuries. Long-term bonds could face headwinds. Instead, look at short-duration bonds, floating-rate debt, and inflation-protected securities, or TIPS. 2. Hedge against dollar weakness. A weaker dollar benefits gold and silver, cryptocurrencies like Bitcoin, and foreign equities in strong currencies. 3. Watch central bank moves closely. The Fed may be forced to intervene, either by slowing rate hikes or stepping in to stabilize bond markets. Smart investors should stay ahead of the narrative. Bonus tip: watch MP materials, MP, Barrick Gold, or ETFs like GLD, UUP, or EMB. They may become increasingly relevant. China is reducing US Treasury holdings to reduce dependence and increase leverage. Bond yields are spiking, impacting everything from mortgages to government debt. Global players may follow suit, threatening dollar dominance. Investors should be ready to hedge, diversify, and adapt. If you got value from this breakdown, smash that like button and subscribe. This channel is here to help you navigate the markets with clarity and confidence. Drop a comment below. Do you think China's moves are symbolic or strategic? What changes are you making to your portfolio? And don't forget to check out the description for links to our resources, affiliate offers, and my latest picks.